Hey guys, Aaron here with Equifirst Lending. I wanted to drop a quick video, talk about some updates in the mortgage market. First of all, I want to pray and hope that everybody out here is remaining safe and virus free. We're doing everything we need to in regards to social distancing to help slow the spread of this virus, and also pray for a vaccine to come to market sooner than later so that we can get a handle on everything that's happening. But due to the virus, there's been a lot of fallout in the mortgage industry. So I want to highlight a couple things, a couple guideline changes, a couple products that aren't around anymore, or by and large aren't around anymore, and then talk about some upcoming changes that we see. Now I don't want to make this a doom and gloom video, but I wanted to just offer the truth. And there's been a lot of misinformation out there, so let's talk about how things are. All right. So right now there's been a lot of changes, specifically in the government lending environment. The government lending environment consists of FHA, VA, and USDA loans. For a large part of the FHA products, those were taken advantage of by people with lower credit scores, maybe not as much money saved up, higher DTIs or debt to income ratios. And what's been happening lately is, due to the fallout from the virus and the rise in potential forbearances for existing homeowners, what that's done is created a crunch for people who are looking to purchase. So lenders have increased their minimum credit score requirements on a lot of those products. Some have halted doing a lot of those loans as well, but the minimum credit score requirements have gone up tremendously. You used to be able to take a FHA loan with a score of 520, 580. The pricing wasn't going to be great at all, but that was more of the norm now. Those minimum scores have raised to 640, and we foresee 660, 680 in the future minimum. So a lot of the lower credit score borrowers will need to definitely get into some form of credit counseling until these guidelines change, or at least to get their scores up while everybody figures things out. All right. So a lot of changes in the non-QM space. The non-QM space is non-QM stands for qualified mortgage. That's any of the outside of the box loan products that were available. I'll give you an example. If you own a business and you write everything off on your taxes, normally we take your tax returns to validate your income, but if it only shows you made $5,000 for the year on your taxes after you write everything off, we can't use tax returns. So a product called the bank statement program was created, where if you have deposits going into a business bank account or even your personal bank account, we can take, in some cases, up to 50% of those deposits and count it as your income, because that's your actual cash flow. And we can trace it and see a solid history of it. We can count that as income. So those products have been halted largely. Now, there's still a few lenders who are offering those products, but the guidelines for those have tightened tremendously. So that's the kind of non-QM space. Also, the jumbo loan space. A jumbo loan is any loan amount that's greater than $510,400. Anything over that amount is considered in the jumbo space. Anything below that amount is considered within the conforming loan limit. All right. So a lot of lenders have stopped offering originating loans in the higher loan amount spaces to help preserve capital while we kind of figure everything out. And so when it comes to the jumbo lending space has been affected, the non-QM space, construction to renovation loan space has been affected as well. Rental income, we used to be able to use rental income for a property that you might own, another property you might own, and use that income to help offset the mortgage for that property. No longer. A lot of lenders have went to discontinuing that. And if you do have a rental property, you have to show that you can afford the house you're buying or refinancing, as well as that rental property. All right. You have to show that you have the ability within your income to afford it, regardless of if that house is collecting rent on it or not. All right. So that's been a big change as well. Things that we foresee happening in the future. So future changes coming up. Down payment assistance and state lending programs. I see some liquidity issues in that area, and I think there's going to be some tightening of guidelines for those programs. Some might even fall off altogether. It might be eliminated during this wash or the backlash from the COVID-19 virus. Having reserve requirements, especially on government loans. they used to allow you to maybe not have any reserves if you had showed enough cash in your house, or they might, as far as refinance, or if you were looking to buy a house, that you might have only needed to have maybe 1, 2, 3 months of reserves. A reserve is 1 month of your future mortgage payment saved up. So 3 months of reserves would be 3 months of your future mortgage payment. So instead of capping at 3 months, they might raise that bar to say 6 months. Some lenders might even raise it to 12 months. So you need to show you can float this mortgage for a year if you went without a job. Again, this is largely due to the effect of the coronavirus and the tons of new unemployment claims we're seeing coming in. All right. So speaking of the new unemployment claims, the forbearances that lenders are offering, I want to make sure that, first of all, if you have the ability to pay your mortgage, I'm asking and begging you guys, please pay your mortgage. All right. It creates huge ramifications on the back end in the secondary market, things you don't see when your mortgage is not being paid. Now, obviously, if you lost a job or had your income reduced and you can't pay your mortgage, please reach out to your lender, your servicer, ask them what their options are. All right. Most likely you'll be offered a forbearance, especially if it was due to this COVID-19 virus. All right. With the forbearance, they'll say, all right, we'll suspend your payments for a certain amount of time. Typically at the end of that period, however many months we suspended it, you're responsible for paying that entire amount in a lump sum. So if you went 3 months, 6 months, 12 months without paying, then you're responsible for paying that entire amount. Now, what lenders will most likely do if you can't pay that amount is they'll take it and do maybe a repayment plan where they'll stretch that entire amount out over a certain period of time, maybe 6 months, 12 months, 18 months, 24 months. And they'll say you're going to pay that, whatever that amount is, in addition to whatever your normal mortgage payment is, so we can recoup that amount that we put into forbearance. Or what some lenders might do is take that entire amount and lump it on the back of your mortgage. All right. If it's added to the back of your mortgage, then you'll have a loan modification in most cases. So call your lender and see what options they have available, because each lender is slightly different. Don't go by the news and say, hey, the news saying, hey, this bank offered everybody will automatically get a forbearance. No bank's offering that right now. Call your bank and see what they're offering to make sure you get the most accurate information. All right. So due to the forbearances, again, things happening on the back end of the market, or should I say the back end of the market, are affecting things on the front end of the market, which is origination. So that's where we're getting all of the guideline changes from, because lenders are trying to slow down the amount of the lower credit, lower reserves, or amount saved up, higher DTI ratio, just trying to slow down the amount of borrowers in that bucket coming through and getting into loans. Unfortunately, for a lot of the lower credit score borrowers, that's just a reality right now. So I wanted to just drop the truth, and I don't think we will be in this for a long time. I think we're going to have some fallout for a while, but I think eventually, once things kind of shore up, once the Fed figures out how much they need to buy in MBSs, and back in secondary market figure things out, the bond market settles down. Once everything kind of balances back out again, then I think you'll see some normalcy coming. You might see some of these products come back to market. Now, some might be changed or altered, but I think we'll eventually see these products come back to market, because they actually covered a huge gap in lending. Just for instance, the FHA program for lower income, lower FICO or lower credit score borrowers, I mean, it created a huge gap, because a lot of banks, their thresholds are high, but FHA said, hey, if you take somebody with a lower score, we will insure this loan. All right. And so it created a huge gap for those lower score borrowers, or people who didn't have as much saved up. So that's not going to just go away and be gone forever. That means a lot of people would not have gotten into a home or won't be able to get into a home. And so anyway, I wanted to make this quick video. I know it's not quick. I'm sorry. It's about 10-15 minutes, but just, drop some nuggets. I'll let you guys know kind of what's going on. I can go a lot deeper into what's going on, but I tell you that with the guidelines changing every day, this information is changing every day. So make sure you trust and lean on your mortgage experts. If you do have a loan in the process, you have a client that has a contract on the property or in the process of refinancing, please, guys, check with your loan officer, whoever your lender is, and ask them, one, make sure your rate is locked. Two, make sure that loan will still fund. because if those two don't happen, it's going to be a lot of issues. Another thing I wanted to touch on is with appraisals. All right, a lot of with the lockdown states, kind of growing rapidly. A lot of the agency loans and a lot of lenders have allowed appraisers to do more desktop appraisals, or maybe they just need to buy the house and take a picture of the outside. They don't actually need to go in to help curb the spread of the virus. So that's one good change that we've been seeing. Another big change is employment verifications. So it used to be where we can do an employment verification at the beginning, toward the beginning or middle of the loan process. Now, pretty much every lender wants an employment verification done at funding, whenever that loan is scheduled to fund. Most likely the day of funding. Some might do the day before, but most lenders are doing the day of funding. So this has changed because they want to ensure that this borrower still has a job when the loan funds. What your situation was 2 weeks ago might not be the same now. And so for lenders' own protection, they're going to do a verification the day of funding. So please prepare your clients, if you know anybody in the process, if you are in the process, let your employers know, your boss, your manager, somebody in HR, hey, make sure you have a good contact, email and phone number, because the lender will call or email and do a verification the day of funding. If they can't complete that verification, the loan won't fund. So please, this is very important. I've seen and heard of stories where borrowers have gotten to the table, signed, and never got the keys because the loan did not fund. So please make sure that this step is not overlooked. You should have been warned by your loan officer or advised by anybody in the mortgage space that you work with currently of this change, because this is not necessarily new change. It's been around for maybe about 2 weeks or so. So hopefully you did get that information disseminated to you. Anyway, any questions, send me a DM, reach out to us. We're happy to answer any questions you have. Aaron, Equifirst Lending, have a great day.